question 31. This question is about a parent company use multiple acquisitions to acquire a controlling interest of the subsidiary company. Okay, so here's the question. On January 1st, 2018, Maury Inc. exchanged $178,000 for 25% of Amsterdam Corporation. Okay, so 25% is only a non-controlling interest. Maury approximately applied the equity method to this investment. At January 1st, the book value of Amsterdam assets and liabilities approximate their fair value. On June 30th, 2018, so half years later, Maury paid $506,000 for additional 70% of Amsterdam, thus increasing its overall ownership to 95%. So now it's a controlling interest. The price paid for the 70% acquisition was proportionate to Amsterdam's total fair value. At June 30th, the carrying amount of Amsterdam asset liabilities approximate their fair value. Any remaining excess fair value was attributed to goodwill. Amsterdam reported following amounts at December 31st, 2018. Credit balances shown in parentheses. Okay, so we have the subsidiary company's total revenue, expense over the year, and also we have the beginning retained earnings, and also note that on October 1st, they declared paid dividends, and also we know the common stock of the subsidiary company. Amsterdam's revenue expense were distributed evenly throughout the year, and no change in Amsterdam stock ever occurred. Using the acquisition method, compute the following. So first one, what is the acquisition date fair value of Amsterdam to be included in Maury's June 30 consolidated financial statement? So on June 30th, the Maury paid $560,000 for 70% of the controlling interest of Amsterdam. And also we know that this amount, the price paid was for the 70% was proportionate to Amsterdam total fair value. Okay, so this equation tells that 70% of total fair value should equal to $560,000, which means that fair value should equal to $800,000. So $800,000 is the answer to this question. Okay, question B. The revaluation gain allowed reported by Maury for its 25% investment in Amsterdam on June 30 will be how much? Okay, so after like half year operation, then subsidiary company may its market value may change a lot more than its book value. Then there will be the revaluation gain. So let's have a look at what happened during that period. So on January 1st, 2018, and Maury paid $178,000 for 25% of the non-controlling interest. So $178,000 is going to be the balance for the non-controlling interest. And during this half year, the balance of the non-controlling interest is increased by its net income earned during that period. So because it only have half year, so that's why we time 1/2. These 210,000 and 140,000 are the revenue of the year and expense of the year. So we use our revenue minus expense, we get the net income for the whole year. And because the revenue expense will distribute evenly throughout the year, so we can use this total this net income times 1/2 is going to give us half year net income. And also because non-controlling interest only have 25%, so we need to time 25% as well. Alright, so then that gives us the book value of non-controlling interest balance on June 30th. So this 186,750 is the book value. And next, what is market value of that non-controlling interest? So market value should be 25% of the total fair value of the Maury. It equals 200,000. So this is the fair value of the market value. And then we use fair value minus the book value, and we get the revaluation gain. So which means that it is more than its book value. Okay, so that's a gain. Question C. The amount of goodwill recognized by Maury on its December 31st balance sheet would be how much? Okay, So, which means that we need to figure out what is the book value on June 30th when Maury obtained the controlling interest. So on June 30th, the book value should equal to its common stock. Okay, so because here we do not have much information related to assets and liabilities, but we can calculate its equity balance. So which means that we can use the common stock and retained earnings to get the book value. So the book value should equal to its common stock and plus the retained earnings. The retained earnings on June 30 should be equal to its beginning retained earnings and plus the net income earned during that half year. There's no dividend paid in the first half year, so there's no dividend. So the total book value on June 30th is this amount. And also we know that on June the 30th, the fair value of Amsterdam should be included at this amount, 800,000. So this is the fair value. So this is the fair value, right? This is fair value. So we use fair value minus book value, and we'll get the positive amount, and then that will be considered as a goodwill. 65,000 is the goodwill. Okay, last question. The non-controlling interest amount reported by Maury on its June 30th and December 31st will be how much? And we just calculate for the June 30 non-controlling interest. So on June the 30th, because on June 30th, Maury have increased its ownership to 95%, which means that the non-controlling interest only have 5% left. So 5% of the total fair value is the beginning balance of the non-controlling interest on June 30th, which is 40,000. And balance of non-controlling interest is increased through net income decreased by the dividend paid. So in net income would be half of the total net income and times the 5%, because only 5% can allocate to the non-controlling interest, and give us the 1,750. Also, on October 1st, the subsidiary company paid dividend, and also so we can allocate 5% of the total dividend to the non-controlling interest, which is 1,000. Alright, so when it goes to the end of the year, so the ending balance of our non-controlling interest should equal to its beginning balance of 40,000 and plus the net income earned during the period and the minus dividend paid, and we get 40,750 as the ending balance of the non-controlling interest.